If you want to understand how systems actually break, stop watching Adversaries. Adversaries are expected to leave. They posture. They threaten. They announce their exits. The real danger comes when the swing states move. Not enemies. Not allies. But the countries that sit in between. Countries that benefit from the system, yet quietly begin preparing to live without it. That is what you're about to see. Because while the financial world fixated on China's $630 billion Treasury exit, calling it the biggest threat to dollar hegemony, another country executed the same pattern. Quietly, deliberately, without making headlines. And then they did something China has not done yet. They physically moved their gold reserves out of Western vaults. 274 tons. From London to Mumbai. Not China, not Russia, India. A democracy. A strategic partner. The fastest growing major economy on earth. This is not preparation for war. This is preparation for sovereignty. And it is far more dangerous. Because when an adversary stockpiles, that behavior is predictable. When a partner quietly removes their wealth from your custody, the system has lost something more fundamental than a buyer. It has lost trust. And trust, once broken, spreads. For 3 decades, India was a model participant in the dollar system. It ran a structural trade deficit in energy. It earned dollars through services, technology, remittances. And like every prudent emerging market central bank after the 1990s, it recycled those dollars into U.S. Treasury securities. It was a boring trade, a predictable trade, a stabilizing trade. India didn't buy treasuries for leverage. It didn't buy them for influence. It bought them for safety. But in late 2025, that trade broke. According to the U.S. Treasury Department's TIC data, between October 2024 and October 2025, India cut its U.S. Treasury holdings by roughly 21%. In absolute terms, the Reserve Bank of India liquidated approximately $50 billion in U.S. debt. Holdings fell from $241 billion to $190 billion. That is not noise. That is not seasonal adjustment. That is not currency management. That is exit behavior. The timing makes this impossible to ignore. India sold treasuries into high yields. In 2025, U.S. Treasury yields were hovering between 4% and 5%, levels that are historically attractive for conservative reserve managers. In normal conditions, central banks accumulate treasuries when yields rise. They buy the income. They lock in the return. India did the opposite. It sold. In the world of central banking, that is abnormal behavior. Because when a central bank voluntarily sells a high-yielding, highly liquid asset, it is not making a return decision. It is making a risk decision. We need to understand what risk they saw. And the data makes one thing clear. India was not forced to sell. Its foreign exchange reserves stood near $680 billion, close to record highs. The rupee was relatively stable compared to other emerging market currencies. There was no balance of payments crisis. No emergency defense of the currency. No liquidity shortage. So the only logical conclusion is that India no longer views U.S. treasuries as a neutral reserve asset. They are viewed as a vulnerability, a liability with a kill switch. We need to identify when that perception changed. India remembers something that many Western analysts forget. 1991. A balance of payments crisis. Foreign reserves nearly exhausted. Default looming. To secure emergency funding from the International Monetary Fund, India was forced to do something unprecedented. Airlift 67 tons of its national gold reserves to London and Tokyo. As collateral. It was a moment of national humiliation. The family wealth, gold, pawned to survive. For a civilization with thousands of years of history, for a nation that had gained independence from Britain only in 1947, sending gold back to London felt like a return to subjugation. India recovered. Economic reforms followed. Growth accelerated. But for decades after, much of India's gold remained stored abroad, primarily in the vaults of the Bank of England. The official explanation was convenience. Gold held in London was liquid. It was easy to trade. It was part of the Western financial architecture. Easy to lease in the international gold market. Easy to use as collateral in the Western financial system. But convenience assumes trust, and trust is what began to fracture in 2022. When the US and Europe froze roughly $300 billion of Russia's sovereign reserves after the invasion of Ukraine, every non-aligned nation took note. This was not a sanction on trade. It was not a tariff. It was not a diplomatic signal. It was the immobilization of a central bank's savings, frozen with keystrokes. India understood the implication immediately. In a multipolar world, where India buys oil from Russia, weapons from France, technology from the United States, holding hundreds of billions of dollars inside Western financial jurisdictions, is not safety. It is a kill switch. If India refuses to align with U.S. sanctions in a future conflict, over Taiwan, over Iran, over something yet unseen, those reserves become vulnerable overnight. Not through military force, not through legal proceedings, through administrative action. India's response was not confrontation. It was insulation. We need to track what they did. India didn't just sell treasuries. It replaced them. Between 2023 and 2025, the Reserve Bank of India executed one of the largest gold repatriation efforts in modern history. Approximately 274 tons of gold were moved from overseas vaults, primarily London, back to India, to secure domestic storage in Mumbai and Nagpur. In some quarters alone, over 60 tons were physically transferred, flown across continents, under military security. This is not symbolic. This is not accounting. This is physical movement of sovereign wealth. Because gold held in London is a financial asset. It is a ledger entry. It is subject to foreign jurisdiction. It can be frozen. It can be leased. It can be rehypothecated. Gold held in Mumbai is sovereign. It is physical. It is under direct control of the Indian military. It is untouchable by Western legal systems. By 2025, more than 65% of India's gold reserves were held inside its own borders. At the same time, India became one of the world's largest net buyers of gold, pushing total reserves toward 880 tons. Gold now represents nearly 15% of India's total foreign exchange reserves, up from 7% just a few years ago. This is not speculation. This is structural de-risking. India sold paper claims and rebuilt physical sovereignty. We need to understand the logic. Here is the critical distinction. China exited treasuries to prepare for conflict. India exited treasuries to remove dependency. China is stockpiling to survive disruption. India is restructuring to avoid coercion. One fractures the system through confrontation. The other delegitimizes it through rejection. That difference matters more than scale. Because China was always treated as a challenger, a strategic competitor, an adversary in waiting. India was treated as a future pillar, a democratic partner, a counterweight to China. And when pillars quietly pull away, systems don't collapse. They hollow out. For decades, U.S. deficits were subsidized by a simple assumption. As emerging markets grew richer, they would accumulate more dollars and recycle those dollars into U.S. debt. The natural bid, the structural support. That model required belief. Belief that reserves were safe. Belief that neutrality was respected. Belief that access would not be weaponized. India's exit signals the end of that belief. The fastest-growing major economy in the world is no longer increasing its exposure to U.S. debt. It is reducing it. That creates a structural hole in demand. China is selling $630 billion since the peak. India is selling $50 billion in 1 year. Combined, $680 billion withdrawn in less than 24 months. And the burden of absorption shifts further onto political buyers and proxies. The custodial warehouses in Belgium, the leveraged institutions in London, the coordinated efforts we identified in Episode 1. The system becomes narrower, more brittle, more reliant on coordination instead of confidence. We need to examine what India is building. India's exit does not announce collapse. It announces preparation. Preparation for a world where participation in the dollar system is optional, not mandatory. The Reserve Bank of India has opened what are called Vostro accounts for over 20 countries. Russia, Sri Lanka, multiple nations in the Gulf. These accounts allow trade to be settled in Indian rupees. India pays for Russian oil in rupees. Russia uses those rupees to invest in India or buy Indian goods. The transaction never touches the dollar. It never passes through New York. It does not require approval from the U.S. Treasury. The volumes are small now, but the infrastructure is being built. Parallel settlement mechanisms, rupee-based trade accounts, energy purchases settled outside the dollar, gold held domestically. These are not anti-American moves. They are post-American risk moves. India is positioning itself to trade with everyone, without needing permission from anyone. That is sovereignty logic. And sovereignty logic spreads. This is where the pattern becomes dangerous. Not because India is large, but because India is a model. If India, a democracy, a strategic partner, the fastest growing major economy, decides that holding reserves in the Western financial system creates unacceptable vulnerability, what signal does that send? To Brazil? To Indonesia? To Turkey? To Saudi Arabia? These are not adversaries. These are swing states. Countries that benefit from both systems. Countries that have options. And when swing states begin insulating themselves, the exits multiply. Not through confrontation, through quiet structural adjustment. We are watching the reserve asset of the global system shrink from a universal safe haven into an alliance reserve asset. The pool of natural buyers is getting smaller, the issuance of debt is getting larger, and the gap between the two is widening. This is not speculation. This is data. We have analyzed the flows. India sold $50 billion in U.S. paper. India bought physical gold and moved it home. India built parallel payment infrastructure. India reduced dependency while maintaining relationships. This is not a collapse signal. It is a trust signal. And trust signals are more dangerous than collapse signals. Because collapse can be delayed. It can be papered over. It can be managed with coordination and liquidity. Trust once broken does not return. Watch gold repatriation, not gold prices. Watch reserve composition, not headlines. Watch who is quietly reducing exposure, not who is complaining loudly. Because systems don't fail when enemies attack them. They fail when participants stop trusting them. India has stopped trusting the system. Quietly, methodically, irreversibly. And once a swing state exits, return is no longer the base case. Here is what makes India's exit more dangerous than China's. China is an adversary. Its exit is adversarial behavior. It signals preparation for conflict. It is expected. India is a partner. Its exit is protective behavior. It signals loss of trust in the system itself. It is unexpected. When an adversary stockpiles for war, you prepare for confrontation. When a partner quietly removes their wealth from your custody and builds independent infrastructure, the system has lost legitimacy, and the question becomes unavoidable. If India, the country Washington is courting as a counterweight to China, does not trust the dollar system enough to keep reserves in it, who does? The pattern is no longer isolated. China exited for conflict. India exited for sovereignty. Different motivations, same mechanism, and the mechanism does not care about intent. It only cares about capacity. China and India combined have withdrawn $680 billion from the U.S. Treasury market in less than 24 months. That selling was absorbed, but not by conviction buyers, by custodial warehouses in Belgium, by leveraged institutions in London, by political coordination, not market demand. And in October 2025, for the first time in 18 months, Belgium's Treasury holdings declined. Not by a small amount, by a significant margin. The shock absorber is cracking. What happens when the substitutes run out of capacity? What happens when Belgium and the UK can no longer absorb the selling? When the hidden bid collapses? That is the next fracture, the custody hub strain. And it is already visible in the data. And when the substitutes fail, when the custodial accounts can no longer absorb, when allied central banks face their own crises, only one buyer remains: the Federal Reserve. The central bank becomes the buyer of last resort, not by choice, by necessity. Unlimited quantitative easing, yield curve control, the monetization endgame. That is the completion of stage 4, and the signals are already forming. Systems don't fail when enemies attack them. They fail when participants stop trusting them. India has stopped trusting the system. Not through confrontation, through withdrawal. And once a swing state exits, return is no longer the base case. The British population did not understand in the 1880s that their capital was building America, while their empire hollowed out. The American population does not understand now that the system they trust is being abandoned, not by enemies but by partners. But the pattern does not require your understanding. It executes whether you see it or not. And once you see it, you stop trusting appearances. You stop listening to what governments say. You start watching what central banks do. Because central banks don't lie. They can't afford to. They move slowly, heavily, quietly. And right now, they are moving away. If you want to track the pattern as it spreads, if you want to see the custody hub fracture before it becomes a crisis, if you want to recognize the Fed's intervention before it is announced, we track what moves slowly, heavily, quietly. We track the absorption capacity. We track the forced buyers. We track the substitutes as they break, because that is where intent lives, and intent reveals the pattern. This is not about India versus the West. It is about a world where neutrality now requires insulation, and when insulation becomes standard behavior, when swing states move gold home, when partners reduce exposure while maintaining diplomatic smiles, the system that required trust begins to empty out, not through collapse, through erosion. Flows don't lie. Welcome to Geopolitics of Money.